Hey everyone, excited to have you guys on this week on our market spotlight ending June 1st. Today we're going to be going over three stocks that are down over 60% from their highs. So with that, let's just get right into it. The first stock that we're going to be going over is one that I probably thought that I would never actually look seriously at, and that is Cracker Barrel. I say I would never look seriously at just because in my mind, probably a little bit of bias that many of these older chains, I would imagine, were just dying off. But to my surprise, Cracker Barrel is not. And we're going to be getting into that today. If you guys are unfamiliar with Cracker Barrel, they are a home-style country food restaurant chain that includes a small store within with other items to purchase. This is their stock chart from their most recent all-time high in 2018. They are down about 74% from their all-time high there. And this is the original thing that caught my eye. And when I looked a little bit deeper, looking at their returns and how their management is able to allocate capital, I found that they were pretty competent in how they've been doing this in the past, which is not always the case. You always want to look for management that really knows what they're doing and can allocate capital correctly. You can see that their median return on assets is about 7.7%. Their median return on equity sits at about 32%. And their median return on invested capital is 18%. Tells me that this company still has ways to deploy capital that are profitable for the company, and they're just the good uses of the money. So really, really like to see this. In the company's most recent quarterly report, they gave 2024 revenue guidance of 3.47 to 3.51 billion, which if they hit the mid-range of that target, that will mean revenue growth of about 1.4% from 2023. This is not a company that's going to be growing incredibly fast by any means, but no matter whether you're looking for companies that are growing really fast or slow, if you can purchase them at the right price, they can deliver the same return no matter how quickly they're growing. So this wasn't a concern for me, but certainly they're not a big grower. They did note, however, that they expected wage inflation of about 5%, which lets me know that they have continued pressure on margins in an extremely competitive business. This is really the main piece that has driven the stock down from its all-time highs. Obviously, there was COVID, but pressure on their margins has really driven their free cash flow and profit down over several years, and it's continuing from what I'm seeing that they have there, that the wage pressure is going to surpass their revenue growth that they expect. With these headwinds, obviously the management understands what's kind of going on here. The company did release a strategic transformation plan on May 16th of this year to revitalize their brand and restaurant, which they expect to grow EBITDA to 375 to 425 million, which their all-time high EBITDA sits at around just under 400 million, if I remember correctly. So this is right around all-time highs for the company as far as EBITDA is concerned. The company also does currently have some solvency issues with only about 12 million of cash on their balance sheet and about 1.15 billion in long-term debt and lease liabilities. Keep in mind, they are still generating about $100 million a year in free cash flow even after the pressure, like I mentioned, on their margins. They're still generating about 100 million per year in free cash flow, which if they avoid falling too much lower than that, they may be okay on the solvency front, at least from what I can tell. They don't have any big debts maturing soon, and they could be fine on that front. In my opinion, for this company, the whole turnaround is going to depend on the competence of its leadership and their experience in turning restaurants back to some growth and boosting margins or cost-cutting efficiencies. Currently, the CEO, Julie Fels-Massino, took over in November of 2023 from the previous CEO. So we don't have a lot of track record for her at Cracker Barrel to know if she has experience in going through these market cycles where they've really got to bring things back to efficiency, cut costs where they can, and boost margins, because their revenue is up over time, but really their EBITDA and their free cash flow, their net income just has not grown at the same pace, and that's the task that she's kind of got ahead. She does have experience with Taco Bell and Starbucks in growing same-store sales, specifically through innovation, coming up with new products, all those kind of things. But we will see how that translates to Cracker Barrel. Taco Bell and Starbucks are definitely different styles of restaurants, which I think means she's versatile. I will say that, but I'm not sure how that will translate to Cracker Barrel. That's more a full sit down, come in, dine in, have a waiter restaurant. That's very different from Taco Bell and Starbucks, as you guys probably are aware. But she does have good track record here. It's a little bit difficult to evaluate whether that's because of tailwinds behind those companies that they had already, behind Taco Bell and behind Starbucks, or if that was her. But I do think she is a competent manager. We'll see how well it translates to Cracker Barrel, though. And I think a ton is resting on her to be able to make executive decisions to make this turnaround. Overall, I would say here, if they do return back to better margins, for me, it's still not attractive enough at this level to only get about a 3.6 return, 260%. This is a hard industry to get turned around in, and they could face a long road, in my opinion, to get back to where they were. It might not be as easy as it looks, and I think oftentimes companies and restaurants can have slow grinds for a very long time of flat to even negative growth, and it takes a lot to really shift sentiment of the consumer to want to come back. Cracker Barrel is certainly a staple restaurant and has been around for a long time, but it's hard. It's a hard industry to really get turned around in. And I'm sure there's some restaurants that you guys can think of growing up that you knew of that were there that just have kind of faded away. You didn't hear of any big blow-ups or anything like that. They just simply got ground down by competition. And it's a very difficult industry. With that said, I am watching this company, and if it gets to around $40, I will do a lot more in-depth work to determine if this could be a good fit, since they do seem to have all the ingredients for a good turnaround play. Down here, I've got it was a very simple discounted free cash flow projection that I put together just to give a little bit of value. And really is what I looked at is I gave them a 16 times free cash flow ratio that I felt like was pretty fair. That's right around the market average. I don't consider them a extremely high quality or low quality company. They probably sit right around average. And if they just grow from where their free cash flow currently sits to just above all-time highs in the next 5 years, then that puts a future stock price of about 260% above where they are now, and a fair value 130% above now. So overall, I do think this could be an interesting play. It's just not at a level that I feel comfortable taking on the risk in this industry that is very hard to be good and turn things around in, and take a bet on new management that I am not quite sure has the capacity to get a good turnaround play. So for me right now, it's just not attractive enough. I have better options. And as Warren Buffett always likes to talk about, when you're looking at other investments, compare them to the current best option that you already have on the table. And if your option on the table is already better than the new shiny thing you're looking at, throw the shiny thing away. And that's kind of what I'm looking at here. It's not attractive enough. It probably won't be attractive enough at 40, but at least at 40, I want to have a very clear picture in my mind of, is this something that I want to purchase at 35? And then I can get ready and prepared to potentially initiate a position here. It will most likely not be large if I do, but it was an interesting one. For now, though, it's pass for me. Moving on to the next stock, Ooma Inc. This was not one that I had ever heard of before. It just popped up in research looking through companies. I looked through hundreds. I've looked through probably tens of thousands at this point, most of them probably multiple times each. But they pop up on different screeners and things that I run just to look for different interesting opportunities. And this is a smart communication software company offering messaging, intelligent virtual attendance, and video conferencing for businesses. You can see from their all-time high, this isn't quite their all-time high, but about in 2021, they are down about 62%. Some of the things that I was drawn to for this company here was their revenue and free cash flow growth. You can see from 2014 until now, the chart of where things have grown, but also if you take a look down here, their free cash flow cumulative average growth rate is just under 25%, and their revenue growth rate is just under 18%. So like I said, I felt this company was worth looking at when I found that steadily growing revenue and free cash flow combined with their 60+% drop in their stock price. However, this is an example that I wanted to bring up of one that I almost immediately decided this was not a company I wanted to be a part of for two reasons. First, this company does not seem to respect its shareholders and continues to issue shares even after the stock has fallen for no imminent, important reason that I can find. They just continue to issue shares because they can, and because of that, every year they issue about 5.5% more shares. That's been their average since 2015, and they've increased the total shares outstanding in these 9 years by about 55%. Anytime a company is issuing shares, it better be for a very, very good reason. And I'm okay if the stock price gets absurdly high and the company is wanting to cash in on that a little bit, issue some shares. But when a company issues shares, it dilutes the current shareholders' ownership in the company. Meaning, essentially, if you buy one slice of the entire company and they go in and start cutting each slice into smaller and smaller pieces, you suddenly own a smaller and smaller part of the company, and you would continually have to purchase more shares just to maintain your ownership level, which to me is just completely disrespecting the people that have decided to put their money with you. You're essentially saying, I don't think that you and your money is worth it. I'm just going to continue issuing shares for no apparent reason in this case. Like I said, there are times when it makes sense to issue shares. If your stock price is exorbitantly high, then it could make sense. Or if there's an acquisition, or if they're in dire need of cash, right? There are situations where it makes sense. Probably not going to be buying a company that needs to issue shares because they're in dire need of cash, but it's a reason. So the other reason was they trade at a 38 times free cash flow multiple, which for a company in a highly competitive industry with no real moats, as far as I can see, is way too high. There are very, very few situations where, in my mind, a 38 times free cash flow multiple would ever make sense. And for a company like this, that, like I said, has no real moats that I can determine, just does not make sense. Their price to free cash flow ratio, you can see, has averaged 77, a median of 32, that latest of 38, a high of 330. Obviously, this can get skewed when free cash flow drops really low, but they're sitting at all-time high free cash flows, just as we saw over here. And for me, that just does not make sense for a company. They're growing their free cash flow at 24% a year, but still, to me, there are better opportunities out there, and they're not respecting their current shareholders and continue to issue shares. So this was almost an immediate pass. From here, let's look at the last company that I actually ended up doing the most work on because I thought it was the most interesting. I actually thought it might turn out to be a potential addition to the portfolio, but you guys will see kind of the conclusion that I came into. And this is the Energy of Minas Gerais company. The Energy of Minas Gerais is a utility company providing services for electricity and gas in Brazil. You can see their stock price from their all-time high in 2012. They are down about 71%, and at different points were down over 90% from their all-time high. They currently generate about 90% of their revenue from the supply and distribution of electricity and about 10% from gas. Doing more work on this company, I looked into the industry to determine if there were tailwinds, and in this specific case, with very little work or in-depth knowledge, it can be assumed at minimum electricity consumption will grow as fast as population, which will be below 1% growth for Brazil's future, I believe around 0.5%. And along with that growth, the country will continue to modernize, which will propel electricity growth further to a fairly conservative 3% per year growth in electricity usage. This company has grown their revenues faster than that, but that is a very conservative, comfortable number that I felt safe assuming here, and let me know a green light, at least from this point, to say, hey, let's look further. For some context of why this stock has fallen from its all-time highs, it's hard to determine the exact cause, but the stock is most likely down in recent days due to major flooding in parts of the country, which has taken out some infrastructure that will need repaired. Also note it's down from all-time highs due to issuance of more shares in different acquisitions. So even though it is looking like it's down significantly from its all-time high, you guys are going to see a little bit later that it might not look near as bad as the chart shows. To address the issues with potential repair due to the flooding, this company has great cash flows for a utility company and good cash reserves of about 860 million, no doubt in preparation for issues that could arise or potential investments in continued infrastructure, just growing their reach as a utility company. The business fundamentals for this company, and up to this point, the stock had looked at least okay, if not a little hard to get information on, but when I started looking at some fundamentals, I found some things that I just did not like and didn't make sense for me as far as how a company was operating. This first one, let's look at their diluted shares outstanding. Over this period from 2017 to 2024, when they started their acquisitions, you can see their shares outstanding increased on average about 10.5% per year, while their revenue only grew about 10%. Now keep in mind, they issued these shares from everything that I could gather in acquisitions, which should be adding revenue, but their revenue wasn't keeping up with how many shares they were issuing, at least telling me, in my opinion, that these acquisitions were not done as well as they could have. It's diluting the current shareholders, and they're not getting as much value back as the company is giving out in their shares. And because they had issued so many shares in this time, their market cap, this is their market cap over this period, is actually sitting right around all-time highs due to how many shares they have issued. So even though their chart shows they're down over 70% from their highs, their market cap sits right around all-time highs anyway. And this was not a good sign for me, in combination with their revenue not growing as fast as their shares being issued. It was not looking great for this company. And on top of these issues, I found it really difficult to find information and details on these acquisitions. I certainly could do more work here, but honestly, being a little bit lazy in this area, I want to be able to have and get these answers fairly easily because I already have good options. If I was in a position where I had no good investment ideas, I needed to put capital to work and just had no idea where to put it, I would do a lot more digging here. But I have the luxury of already having some fantastic companies that I can put money to work in right now. So I have no reason to go to all this effort to look into this company, especially when I look into here, I will most likely only be looking at 180% return on multiple expansion to say around 14 times free cash flow, which I think is appropriate for a utilities company. Certainly this company has traded far below that in its history, but I would say that is fair. for a utility company. They're not going to be a great grower. It's going to be slightly below the US's free cash flow average multiple for a company, but right around what I would say is fair for a company that's more stable than most. And then they also currently have above a 10% dividend yield, which are solid. Don't get me wrong, 180% return just in multiple expansion and a 10% dividend yield on top of that. They are very solid for a utilities company in Brazil, but I just can't seem to get information on it, and it's just not enough. Especially like I mentioned before, when I compare it to other companies that I'm already invested in, I have greater confidence in my ability to understand them and have a greater expected return. So for now, this one was a pass. I did put a watch on this company quite a bit lower than it's trading now, but it might be worth a look later if it falls significantly from this price. Not sure it will ever happen, or even if it does, if I would ever invest here, but it was at least worth a look, and I thought I would share it with you guys. So that is everything on the 3 companies that are down 60% or more from their high. And I'm just going to be sharing with you guys information on the current holdings that I already have. I always like to share news and updates that I thought was relevant. So with that, we're going to jump in there. And I wanted to add something that was a little bit different that I have not added before. And I'll probably continue, if you guys like it, is giving updates on how my portfolio performed versus the S&P 500 each week, probably at the end of each month as well. Maybe we'll start that, maybe not. We will see. The portfolio this week was down about 0.37% versus the SPY, which was down 0.29%. Pretty close to in line. Definitely, I am not always in line. I've had weeks where I am up significantly while the SPY is down and vice versa. But just thought it was interesting, and I'll start sharing that with you guys so you can see how I'm actually doing against the S&P 500, which in my opinion is the premier benchmark to go against that everyone can understand and know. So with that, let's get into some of the news. First off, wanted to share some information with you guys about Warner Brothers. Zaslav, which is the CEO, said he sees M&A opportunities in the next 2 to 3 years. There are a lot of players that are losing a lot of money out there. This is a highly, highly competitive industry in streaming and in content creation, really with probably Warner Brothers, Netflix, and Disney right around the top battling for who's going to take share. There are other companies that are really trying to get a foothold here. And I thought this was interesting to look into the future and think about what could potentially be happening here, whether Warner Brothers is going to be purchasing other smaller streaming platforms. In my opinion, they currently do have quite a bit of debt, so I'm a little apprehensive at this statement that they could be taking on other companies. I don't think it's going to impede their ability to generate cash, but it could push out that timeline to really, really get profitable. They are making fantastic progress there, in my opinion, but still have some ways to go. So we will see what happens there. I thought it was interesting. Some news on Alibaba from the South China Morning Post. Alibaba invests $27 million in education startup to expand its generative AI portfolio amid price war in China. Alibaba is an absolute beast when it comes to having additional cash on the balance sheet and putting it to work. The company is currently purchasing extremely large amounts of its stock back. It's also investing into itself and pushing its reach. And when it has the opportunity, it is investing in other AI startups in China. And if you guys know China, I'm certainly not the foremost expert by any means, but I feel like I have a little bit of grasp on where things are at. China currently is behind the US in terms of automation. And so their real AI wave like the one that we've seen recently in the US, is just kind of getting going in the cloud, where Alibaba is a huge player. And I love how they're putting their money to work here. They have a ton of investments like this, where oftentimes they're actually not fronting the full amount of cash, the 27 million, but they're giving a large chunk of it in cloud credits, meaning these AI companies can use their cloud system essentially for free until they've utilized all their credits, and then they still have to pay them, but they're integrated into their system and they get a permanent equity position. So love this news from Alibaba, just continuing to do some great things. Some other news on Alibaba as well. They expanded their cloud reach and AI capabilities. Reading this article, I thought it was very interesting, and I'm loving to see how big of a player these guys are going to be in Southeast Asia and other places around the world. They said that the company plans to launch its first cloud region in Mexico and establish new data centers in Malaysia, Philippines, Thailand, and South Korea within the next 3 years. This expansion aims to meet the growing demand for AI and cloud services across various industries. These guys are going to be able to capture and retain a lot of business, which could be huge for them in the future. These guys could turn this into the biggest part of their business. Currently it is retail, but we'll see kind of where this goes in the future. It's really, really exciting to be a part of this company. They're the largest holding I have. So always good to see the things that they're doing. Just some quick news on Boeing. They were awarded a $7.5 billion contract for St. Charles made smart bombs. Boeing is a company that has unending terrible news, but that's okay. I hope it just continues to push the stock lower and lower so I can buy more shares. It's probably one of my highest conviction investments. It doesn't have the most amazing return, but just because of how high quality and how high of a conviction I have in the company, I have no problem with that. Occasionally, I will take investments here just to get a little bit of diversification. Boeing operates as a duopoly, and I'm excited for their future, continuing to get awarded business, even with the bad news, which lets me know this company is not going anywhere. Last piece of news, IMF ups China's 2024 GDP growth forecast to 5%. China was telling us, hey, we are going to grow at 5%, no matter what it takes. And everyone in the world said, we don't believe you. And now guess what's happening? It's always interesting to see China saying, hey, we're going to do this no matter what, and throw money at the problem. And the world says, no, you aren't. China's going to blow up, and we can never put our money to work here. We can never invest. And now all of a sudden people are realizing, oh crap, they are doing exactly what they said they were going to do and have been telling us for a while. So some other good news for China, which will benefit an options play that I have there. It's longer dated. It's already up about 150% on that position. Still have a ways to go before I look at closing it. But some good news will help Alibaba, will help that options play, as well as Dokao, which is a solar play on China. You guys can watch previous videos to learn more about those. But some good news here. Very excited for these futures. So with that, guys, I really appreciate you being here. Let me know if you have any questions. You can throw them down in the comments. I am happy to help in any way. Looking to grow here, grow my knowledge, grow my understanding. I put a ton of work into this for you guys, and I absolutely love this stuff. I do this every single day and put a ton of work into hopefully providing some valuable content for you guys. So with that, we will see you in the next one.